Mike,
I think
you've been
that's
playing a lot
I
with
think that's a
one-year
valid
rates.
interpretation, and would also highlight the dynamics of we're beginning to see the employment gains on net. Total employment has basically been stagnant for several months. Again, as Lynn points out, there's likely to be revisions to that data. We've seen multiple downward revisions in a row now. That tends to be one of the characteristics that people look for. And I would also highlight how difficult the data is this time around, right? Because we have this extraordinary impulse that occurred both to the downside and to the upside. It's really hard to understand how are we supposed to seasonally adjust data, for example. How are we supposed to interpret the recovery as rapidly as it's occurred, for example, in the labor force? If anything, I would suggest that what feels like very elevated levels of inflation, once we start to factor in things like the supply chain disruptions that we've experienced, or the extraordinarily low levels of inventory that we had for a product like single family homes, where there was a very fundamental outward shift in the demand utility function associated with having a single family home, because you were no longer in a city, right? You no longer you needed to have a house that had an office in it, for example. That raises the value of single family housing quite dramatically. And I'm not surprised by the dynamics that played out. The question is, how does it recover from here? What does it behave like going forward? And that's where I find, and again, it goes back to the arguments that I was making a year ago, which is, if you look forward from now, I just don't see the impulses barring another stimulus response. And if anything, as Lynn is pointing out, the likelihood of Republicans taking back seats, et cetera, we're right back to the no action government, far from the MMT dynamics that we were celebrating 12 months ago.
I agree. I think that my outlook is less for the demand side and more for the supply side, because I think that, so for example, in the 70s, even when you had recessions, and again, there are a lot of differences from the 70s, the type where the money supply growth is coming from and all that, but one similarity is that in the 70s, domestic oil production in the US peaked in 1970. It started entering a plateau and then a downtrend. We became more reliant on the Middle East and then all the geopolitics there. So we had, serious supply side problems combined with the fact that money supply was going up back then, mainly for demographics reasons. And so here, it's not that I expect the demand side to be particularly strong. It's that I don't see any significant relief coming on the energy side. And so I think that some of the realignments around purchasing, as you pointed out, could be easing. But I do think that the energy side is still completely unaddressed. We still don't see any sort of uptick in CapEx. We see they're still drawing down drilled but uncompleted wells. So they're basically picking out the easy ways to get more supply online. They're not actually doing the long-term projects to get new supply online, especially with oil futures priced that low. There's not a lot of incentive. And so I think that it's back in the 70s, even when you had recessions in the 70s, you still had inflationary recessions. And so I think that, we're used to recessions and economic decelerations being disinflationary over the past years and decades. And I think that in this dynamic, we're not necessarily going to get that we can have a slowdown in demand, even a recession in demand, and yet still, holding energy prices down is like holding a beach ball underwater, where maybe demand destruction tapers it off for a period of time. But then as soon as you have a resumption in growth, either due to a round of stimulus or something, it's ready to pop back up. And so I don't see any sort of relief on the supply side, at least in the energy space, which trickles into almost everything else.
Lynn, so you've been overweight in your model portfolios in energy oil, as far as I can tell. That's worked out very well. Congratulations. Without mentioning tickers, can't do that. You still like this sector, it sounds like, because you think if the world prices up the forward curve, and forwards are well under 100, and you think it's going to be rising up, that would intend to imply that there's continued value in that sector. Is that true?
Yeah, I would say the current oil stock prices in general are not reflecting. They're not reflecting how high oil could go, 3, 4, 5 years out. And so while I would be cautious around near-term oil itself, I still like the oil equities. Now, they have come pretty far, pretty fast. So I always get nervous when sentiment is in my favor. And so I wouldn't be surprised after we get past the summer to see, a couple quarters of stagnation. But I think looking back years from now, they're still reasonably attractive. And I've also been focusing on the pipelines. If someone wants, exposure to the sector, but they're less clear about energy prices, I think that the pipelines have been so bombed out, basically. For years they were kind of doing Ponzi-nomics. They were issuing debt and equity kind of in this constant growth. That all blew up in 2014, 2015. And then a couple stragglers that didn't blow up then blew up in 2020. Only the really strong ones got through that whole period. And they've shifted now, they're not even really issuing equity anymore. They're more self-funding. They grew their distributions slower than their cash flows growing. And so they purposely have lower payout ratios so they can funnel more of their own cash into their growth projects. So they don't have to constantly issue equity. And some of them are actually buying back units, which kind of defeats the whole purpose of an MLP structure. But that's the market that we're in now. And so given the valuations I think are still low in that sector, I actually like them compared to many alternatives. And so I think that's one way to play it as well.
I agree. Strictly back to my wheelhouse of interest rates. Looking from the poll, people seem to think we're going to have a 5 handle on inflation come the end of the year. That's good enough for me. It's coming down, but we're not seeing 2% for quite a while. And let's just say we are in a recession or we're nothing right now. Let's say we're 0 for real growth. That gives me a 5% nominal. Mike, I have a chart up there about this. Historically, we've seen some kind of relationship between nominal GDP, which, by the way, despite last quarter's -1 and change, headline number, the real number was positive 6.3, which is the nominal GDP growth. We've seen a relationship between cash 10 years and nominal GDP, which makes sense fundamentally because like the cost of capital and the growth should be kind of aligned with a small profit. That would kind of mean that we have a 5 nominal GDP in December. Where's that put 10 years at? Still at 3?
So let's share that slide quickly. And I guess the question I would ask you, Harley, is based on this, what would you, if I look back, for example, at the 1960s, where we saw the first wrinkles of inflation begin to emerge in that cycle, we didn't see a meaningful response from tens.
No,
right?
we didn't. I mean, yeah.
So why would we expect it this time?
Well, I mean, I would argue last time that people couldn't believe their eyes when they saw the inflation numbers that high. It took a while for it to bleed into the system, which it did slowly. I'd say right now it's kind of the same thing. We really can't process an 8 or even a 6 handle. I don't know. I think I'm a U Chicago guy. I kind of believe there's a fundamental to this. It's once again, it's a squiggly chart that can be made to look like anything, but it kind of makes sense to me. And I'm just wondering about, how do we have high nominal GDPs, high inflation, but high nominal GDP and not have higher rates? And I'm trying to process how the curve is inverting at 275. I mean, yield curves invert before the recession. They invert usually at the second to last Fed hike. We start inverting here like before the first hike. This is like kind of crazy town. Something's wrong here. I mean, I think, and I can't figure out which one it is. The bond market's the wrong price, or the curve's the wrong price, or maybe it's the Fed's heavy hand. I mean, I have proposed that you've seen mortgages blow out 75 basis points versus treasuries in the last 6 months. I'd say maybe the mortgage market's the right price and treasuries are the wrong price, have to catch back up to them. But I have a hard time processing a 5 or 6 handle on nominal GDP and a 3 handle on tens. Something doesn't work for me.
Well, so I would say there's 2 separate components to it, right? One is that the nominal GDP is a backwards looking measure, right? Whereas a 10-year rate is the next 10 years. And so this can very easily be resolved by simply saying real growth is going to be much slower than you expect, and nominal growth is going to be, within expectations of kind of 2 to 3%.